Hello there and welcome to the Rubicoin podcast, coming to you from the top floor of Rubicoin HQ in Dublin, Ireland. With me this week is Emmet Savage, CEO and co-founder of Rubicoin, Rory Meabh, our chief analyst, and Maeve Redmond, the head of customer experience design. I'm James Dunn, and this month we're going to talk about match swiping left on Facebook, why Elon is getting prickly with investors, and why Emmet is adding more cash to his portfolio this month. We're just emerging from the business end of the latest earnings season, and over the last few weeks we've gotten some insight into how most of the 97 companies in our 1% showroom have performed in the first quarter of 2018. It's been a pretty good start to the year for most of them, but there were some big stories to emerge from the earnings seasons too, none more so than the new rivalry between the Match Group and Facebook. 2 weeks ago at its annual developers conference, Facebook announced that it is set to release a new dating service on its native platform, causing Match shares to plummet more than 25%. But then, last week, the Match Group posted strong quarterly results itself, and management said that they have no fear of Facebook competition. They even went as far to say that Facebook's product will be great for US and Russian relationships, and that users typically want to keep their dating life separate from their family and friends. Shares in the Match Group have recovered since these comments. Emmet, do you think that it was somewhat of an overreaction, the initial drop?
I'm absolutely sure of it, James. We need to compartmentalise aspects of our life, and romance and dating requires, I suppose, a specialist product as opposed to social networking. You don't want to go onto Facebook for multiple purposes. I think you go there to post a picture of a hot dog or a cat, and you go on to Tinder to swipe left or right. I mean, I particularly liked Match's results there last quarter, and in their recent Q1 numbers, subscribers are up 87% year on year. But what I found particularly interesting about Match is that they have a renewed focus on user safety, security and engagement.
Yeah.
So, for example, on the safety side of things, they're implementing controls that allow women specifically to decide who sends the first message. In-app they have a timeline which is designed to increase engagement and is actually cutting through. And as a team here who runs a business based on a mobile product, we know the importance of making sure your product's engaging and brings people back without calling them. So very interested in Match. I'm not particularly worried about Facebook as a threat. We'll see, time will tell, but with Match's absolute dozens of apps for every specific need or desire, I don't think Facebook can really compete with that.
And leading on from that, you mentioned user safety, but there's the data safety question too, I suppose. Rory, would you trust Facebook with your dating data?
Absolutely not. And just to echo some of the things that the Match management said, when I first heard this, I thought this was bizarre. Like, no one really wants to link their social media accounts to their dating apps. Having used dating apps, met some very nice people. I've also met some people who I hope never find me, because there is strange people out there, and I'm sure female point of view would say the same about some men. So you want that distance, and on top of that, doing it on the Facebook native app seemed very strange. I mean, if they'd said Instagram dating, I'd have thought, yeah, that actually sounds plausible, because Instagram has a lot less kind of your personal information on there. It's a lot more just image based, and it's what people are using. I don't know many 18 to 35 year olds use the Facebook native app for much anymore.
Yeah, good point. And I suppose we're I certainly am in the dark about what this product actually is. Maeve, do you know what is Facebook offering that is different than what's out there already?
Well, I had a look at the actual video demo of what the feature will look like. So it's going to be called Dating Home. It will be accessed from the native Facebook app. Yeah. It will be opt-in. So it's something that you'll very much decide to do, although I do agree with Rory that there are privacy and identity concerns. But my interest is slightly more piqued than Emmet and Rory's. I know that they're going to use local events to try and link people together, which is getting slightly more close to how we would have met people in real life. So I use Bumble sometimes as a dating app, and that's very much set up so that the woman sends the first message, but it would be nice to think there would be a feature where you can meet people at events you would have been at anyway. Yeah. Because you're getting slightly closer to social circles there. So yeah, I'm slightly more curious, but also fairly cautious.
Yeah, so they seem to be kind of approaching it that it's a different way of finding people who maybe share the same interests as you.
Yeah.
Yeah, well, I mean, on that point as well, like, yeah, the user experience is very different. It doesn't look like Tinder or Bumble at all. And then the other point is that it's not a zero-sum game. I think most people have a couple of dating apps, so they're not just going to ditch one to use the other. I think they can live side by side with each other.
Yeah. To put our investing hats on, Emmet, is this the chance to buy the match dip then maybe, or should we wait and see what kind of transpires?
Over long term, I'm a buyer on Match. Like the business, like the prospects, I like the vision.
Interesting. Okay, cool. Other big stories from the earnings season then include Chipotle. Surprisingly, we got some good news from Chipotle this earnings season. Brian Niccol, the new CEO, got his tenure off to a great start, with the company smashing through earning estimates, a 7.4% rise in sales, and average check size rising by 4.9% during the quarter. Going forward, the new boss has said he'll be focusing heavily on digital marketing and menu innovation. Rory, does this mean that we maybe no longer have to worry about a power struggle between Niccol and former CEO and co-founder Steve Ells?
Well, Ells didn't even go on the earnings call, which I think surprised a lot of people. I thought he was going to make an appearance, and that probably is addressing those fears. My sense from the call was that Niccol is an excellent choice for this role. He's a guy who's known for menu innovation. He's a guy who's known for his ability to integrate technology into the restaurant space. And these are two things that Chipotle have been very weak on in the past. Moreover, I think we think about Chipotle as a higher standard of food, certainly relative to someone like Taco Bell. But if you compare the company's two safety records over the years, it's easy to see who's winning that battle. Listening to him he's planning to expand delivery, he's planning on expanding catering, and that's all well and good, but it doesn't sort out the image problem that Chipotle has, and it certainly doesn't get those customers who have left back through the door. So for that, they need two things. They need a sustained period without these foodborne illnesses, for one. And secondly, they need to give people a reason to come back and try the food again. And that's where menu innovation comes in. And Chipotle has been known in the past for having a very simple menu, but consumers these days are very fickle, and there's a huge variety of options out there. So what Niccol was great at was bringing in new items to Taco Bell. It wouldn't be the kind of food I'd go for, but it got people talking about the brand, and it generated foot traffic into the stores. Now, I don't think they're going to be able to go down the same route with Chipotle in terms of doing things like fried chicken skin taco shells or something like that. But like introducing something as simple as tacos would be a big move for the company. And then, further down the line, Niccol brought breakfast in at Taco Bell, so why not breakfast burritos at Chipotle?
Yeah. Good. I know it's quite short-term success we've seen at Chipotle over the last few months, but it leads to the wider question of at what point maybe should a co-founder step down, a co-founder like Steve Ells step down and let a professional CEO into the space.
Yeah, that's true, James. It's horses for courses, really, and as it is in sport, there are people with defined roles and skills. Specifically in baseball, for example, you have clear roles and responsibilities and strengths that are playing to the pitch, and same in the world of business. We have CEOs that are ideal from a brainchild to building an early stage or growth stage brand, and you have CEOs who have speciality in taking a brand that's already recognized to the next level. It's very, very rare that you'll find a chief executive who brings a brand from their bedroom, if you like, right through to global domination. It takes different people for different stages.
Yeah, speaking of famous co-founders and CEOs, another company that had some interesting news this earnings season was Tesla. It was a pretty mixed quarter for Tesla, posting its heaviest loss ever, but they're finally starting to hit those production targets, albeit a few months late. The real talking point, I thought anyway, from this earnings season was CEO Elon Musk. He's getting increasingly prickly towards reporters. In the earnings call, he said that boring, bonehead questions are not cool, and that those questions were so dry they're killing me. Emmet, you picked Tesla as your company to watch this earnings season, the last podcast. What do you make of this?
Yeah, well, I have a strong opinion on it. We focus on investing in the vision here at Rubicoin. We find businesses that are looking to the horizon, and indeed who are saying there is no horizon. We are actually going beyond that horizon. However, the stepping stones to a vision are quarterly reports and results.
Yeah.
And it's just a fact of life that a CEO who has decided to go the Wall Street route must answer questions from Wall Street, whether she or he likes it or not. So I guess fusing a planet-changing vision with quarterly or annual financials is difficult. But I think Elon Musk is going to have to just, get on with it. So I wasn't overly impressed. I could understand why he found it irksome. But it wasn't, I think, his most enlightened moment. But this is it. He's a visionary.
Yeah, Maeve, you've always been an outspoken fan of Elon Musk. Can I say that with inverted quotes? But what do you think? Do you think it's kind of a case of he's the brain behind Tesla, but perhaps not the tact?
I think you should be able to do both at this stage of the game. You know, like, I'm still observing things that he does that makes me slightly unsure about him, and of course the innovation is astounding and it's all very exciting, but okay, if you're going to go and talk about flamethrowers on Twitter, then you should be able to also row back and be the type of leader who can answer questions about profitability and, you know, production numbers, and after a high cash burn, like Emmet mentioned, you should have like distinct answers to those questions for analysts, and you should have no problem in doing it. It's your job.
Yeah,
I think he kind of feels like he's probably answered these questions an awful lot before, and it is kind of just, you know, like, in one way he's right, they are boring, they are dry questions, and I say that as someone who like lives off this stuff. So yeah, I mean, I can sort of see why he flipped the lid a bit there.
Yeah.
Well, Tesla has burned through $4.4 billion in the last 12 months.
It's
The
incredible.
question is, yeah, but how much cash do you need to revolutionize an industry that's been around for 100 years?
Yeah.
You know, so that's all very philosophical, but yeah, they've lashed through the cash. However, revenue did grow 26.4%. So revenue came in at about 3.4 billion versus what analysts were expecting, about 3.3 billion. So the trajectory is going in the right direction, and that's actually the trajectory that's pointing at that vision.
Yeah, as long as they can keep producing those cars. Next few months are going to be very, very interesting there, I think. We've talked about some of the bigger names in our showroom, but there were varying fortunes for two of the smaller companies in the Invest app too. Shares in MindBody, a provider of management software for the wellness industry, dropped off a tepid outlook for 2019 and remained down about 10% from last week. On the other hand, one of our other smaller companies, the Trade Desk, smashed through its earnings estimates on Friday, sending stock rocketing about 43% in just one day. I think that was actually the biggest one-day jump for any stock we've experienced in our showroom so far. Rory, when you see such varying fortunes for two different companies, how do you approach it as an investor? Is this just the risk of investing in smaller cap companies?
Yeah, I suppose the problem with these kind of companies, they don't get the same kind of news attention that you'd expect from someone like Amazon or Tesla or Google. So you do really have to dive in and see what's causing a sell-off or what's causing a jump. I suppose when you see a jump, you don't really care what's causing it. You're just happy to see it, a lot of investors would say. These two differing outcomes for them over the week. MindBody, what happened is they beat their earnings results pretty handily, but their guidance was a lot lower than was expected. And that all seems to stem from this recent acquisition they made of a company called Booker. Booker is a network of over 10,000 spas and salons, which is an area MindBody's been in the past, but they've never really been very strong in it. So they decided to buy out Booker rather than compete, essentially. Yeah. And what happened was Booker last year had revenue of about $25 million. You would just then expect MindBody to add at least $25 million to their guidance for the year.
Yeah, basic maths.
Basic maths. At least. You'd hope at least it would be the same if the company's growing. And what happened is they only added 16 million to their guidance. So that caused a bit of confusion, and management didn't really help matters by kind of not explaining to the analysts on the call where that divergence was. They kind of refused to look at Booker as a separate entity anymore. They explained that, well, Booker was only being part of the business for 3 quarters rather than 4, and that some of the clients that Booker had wouldn't really be their target market, so they wouldn't be serving them anymore. But I think it just brought up a bit of uncertainty over what was causing that drop. Is it Booker that's not performing? Is it organic growth that's not performing? And if there's one thing that investors don't like is uncertainty. So that caused the drop. I think listening to the call, management were just being very conservative. It's 2 big companies they're trying to combine now, and they're just taking a very cautious approach in terms of what they're guiding for. On the other hand, the Trade Desk, definitely, I'm confident it's definitely the biggest jump we've ever seen in a stock, 43% in one day. It's not the kind of move you tend to see in companies like this, even though the Trade Desk is a small cap company. You usually see a drop of 43% if a company missed or gave terrible guidance, but to see a jump like that is usually reserved for kind of small cap biotechs who've maybe just had a massive success in a clinical trial. So the steal in the trade desk was unusual, but not undeserved. They had an incredible quarter. Revenue was up 61% year over year. They almost doubled their adjusted earnings per share expectations. And the real story here was spend on connected TV, which went up 2,000% year over year.
Yeah. And
then of its new channels, you saw spending on audio increase 650%, and on connected TV, spending surged more than 2,000% year over year. And so the story here that investors are looking at is that, you know, we talk a lot about companies like Netflix and Amazon and their over-the-top streaming, but what we don't remember is that there's still a huge television advertising business out there, and it's not going away. There will be over-the-top streaming supported by ads, which will be free. So just looking at another company that is in that realm, there's a company called Roku, and in their first quarter, they had 5.1 billion hours of streaming through their platform. It was up 56% year over year, and the fastest growth from that came from ad-supported content. Okay. So the Trade Desk is the company powering this ad-supported content. They're the ones getting the ads in front of us and telling companies where to put those ads for the best results.
So it's really a different model from the Netflix streaming many of us might be used to. This is no subscription fee, but you're paying through watching the ads, essentially.
Oh yeah, totally. And people are happy to do that. You know, it's great to not have ads in front of your Netflix shows, but if there's a show you want to see, I think people are happy enough to sit through two or three adverts beforehand.
To go on to kind of a wider investing question, if we compare the movements between Mindbody and the Trade Desk, so at the time of recording, Mindbody was down about 10%, the Trade Desk up over 40%. Emmet, it's interesting though that from investors we often get a lot more questions about why a stock might be down 10% rather than why a stock might be up 40% or more.
Absolutely. The pain of loss is far greater than the pleasure of gain. I think loss aversion theory states that, in fact, the pleasure of getting something is only half that of losing something, or in other words, pain is twice as felt as pleasure. So if you win $50, you feel a certain way. If you lose $50, you feel another way, and generally the negative is twice that the positive. So it's unbelievable, really, because it's illogical. If you look at the showroom that we've built and the performance of the stocks that we've published, it's quite exceptional, really, if we can just throw roses at ourselves for a second. But it's just human nature that someone will run to the bottom and say, right, okay, so you've a dozen plus stocks that are up 100+%, but what's going on at the other end?
Yeah.
And so you buy a stock, and as the world has it, generally it will go below your buy price within a few days. That's just the way it works.
Yeah.
And that hurts because you question your logic. You wonder, well, clearly with hindsight you see you should have waited, but at the point of buying you can't feel that. So yeah, we are usually quite inundated with questions when the stock goes down. But what I would say at the moment, the market is responding to news, quarterly results, as it always does, in an exaggerated way. So what we're seeing with Mindbody and with the Trade Desk is an exaggerated response to just another day at the business.
Yeah.
Now, granted, as I said already, the quarterlies are a stepping stone to the vision. And our businesses have a vision. They're both on the right track, but just money flows in or out based on the news of the moment.
Yeah. Another question we actually frequently get in from members of our invest community too is it's a pretty simple one, but when you dig under the surface, it gets a lot more complicated. When do I buy? And I know that you've been adding some new cash to your portfolio recently for the first time in a while. Why now?
Simply because I'm in a position to do so. And that is the rule of thumb. You buy shares when you have some cash accumulated in your life that isn't destined for an obligation. So I haven't been in a position to add new cash to my portfolio for a couple of years.
Yeah.
Starting a high-tech business in Ireland is not cheap, and as it happens, I'm now in a position where I can start to add money, and there has never been a bad time to buy stocks, just sometimes are better than others. So really, I have spare cash available at the moment. I've decided to deploy it. I'm alive now. There's great businesses now. I see more great opportunities today than I've really ever seen before. So, and I acknowledge that the market is at or near its all-time high, but that has been the storyboard for 100 years.
The last 2 years.
Well, this
yeah.
is true. Well, for the last 2 years especially, but at any in any adult lifetime, there is a point at which you can say the market's at an all-time high, and that's just the way it goes. Businesses get more productive, they get more profitable, and the market ultimately goes upwards.
Yeah, and interestingly, I know, I'm sure you don't mind me saying that one of the stocks I know you've recently added to your portfolio is Teladoc, which also happens to be our most recent stock of the month. Do you want to explain maybe a little bit more about stock of the month to our listeners? You know, how does the stock of the month differ from other selections in our Invest app?
Absolutely. So we've published, we call it our 1% our showroom, which is hand-selected 1% of the listed businesses out there. So it is a shortlist. Our stock of the month is a shortlist of the shortlist, and it effectively is the one stock that we three, you, James, Rory and I, feel most optimistic about at this moment in time. So we, as you know, pitched to each other our ideas for stock of the month, and I think the three of us always feel comfortable that if our kind uncle was to hand us $10,000, that we would be happy to invest it immediately and at this moment into our choice of stock of the month. And we need to be able to explain to each other why that is in fact the case. And what I would emphasize is that we won't get it right every time. That's actually impossible. No investor has ever gotten it right every time. But over the long term, which for sake of conversation is about 7 years, we'll get about 7 out of 10 right.
Yeah.
7 out of 10 will beat the market, is what I mean by right, and three will have underperformed the market. So it's really what we're simply doing is we're putting our finger down on one of our published stocks to say this is the one that at this moment in time is most appealing to us, and the reasons for that are explained in the write-up.
Yeah, and it's interesting, Rory. I suppose the next question people might have is, for a company that advocates long-term investing so much, how does recommending a certain stock on a certain month fit into our long-term philosophy?
I'd say the first answer to that is people should be investing regularly. If they can be investing month in, month out, that's great. If not, they should invest whenever they can. The other point is that it's not necessarily a buy this stock right now because we told you to buy this stock. It's what we're trying to do with the report, and I think that comes across, is trying to give an insight into our thinking. And it's an educational tool as much as every other part of the app. Why do we like this stock now? And that'll help other investors to clarify their thoughts as well. Yeah.
Maeve, as the member of our team probably who converses most with the outside community, outside invest community, how do you find people kind of react to stock of the month?
They like it.
Yeah.
Yeah, from talking to Rubicoin customers regularly, I can tell it's one of the more kind of focused, regular pieces of content that they dig.
Yeah.
I think we were talking about this recently, and we used the term, it's the dish of the day, you know what I mean?
Yeah.
So you're presenting a short list of a short list. It's very nice when you get a short menu because you see the thing you like straight away.
Yeah.
I think because it's a focused piece of content on one stock, it also allows them to make the decision on whether they want in or not.
Yeah.
And then also related to the previous conversation on kind of when to buy and then when to feel bad if there's a dip, I think with stock of the month and when to buy, one thing I know our customers, and actually I learned from personal investing experience, is when you have cash flow, fund your account.
Yeah.
So that you're not in a position where you might see something that we either publish or release and that you want in on that you can't get.
Yeah.
And then just on loss aversion and feeling like maybe if we were to publish a stock and there is a dip, for me, what I've learned and what I feel kind of fully comfortable with now is it will be an unrealized loss if you're in long.
Yeah, okay,
so
that's a good point. Yeah,
that makes me feel much better now when there is a stock that I buy in on and then there's a dip. Of course, long term things may not work out exactly how you wanted, but I think people panic regularly, and I think what Rubicoin tries to do is just keep endorsing this idea that this is a long hold position. Things will change and you got to wait it out.
Mm-hmm.
That's interesting, Maeve, and I know that's something you've mentioned a few times, Emmet, is the power of always having dry powder kind of at hand.
Yeah, it's a fact. Every professional investor out there knows from experience that you keep some cash on the sidelines. Personally, over 20 years, I have never been more than 5% in cash.
Okay.
Which means I've been highly exposed. And in fact, practically speaking, in my life, when the market has gone south, as it has done, and I've been invested through 2 of the 3 biggest downturns of the last 100 years, when the market does go south, I just go looking for new cash. It's not that, I have money hidden under my pillow, but when things are on sale, you kind of go and figure. So that's how I did in the early stages of my investing life. But yeah, keeping some cash on the sidelines is, one of the secret weapons to getting bargains when they present themselves. A case example was the other day we saw Match getting crushed. I think it was around 18% an hour or so after Facebook made their announcement. And that's an example of an irrational, if you ask me, an irrational response to rational data.
Yeah, interesting. In the last episode of the podcast, Emmet and Rory, I asked yourselves to give me a quick 30-second elevator pitch about the one company you would be looking closely at this earnings season. For this episode, I want you to give me a company that's outside our showroom that you're looking at now, perhaps one that's on our short list or our long list for possible addition to the app. Myself and Maeve are going to judge you then on your pitches after to see which one we'd be most invested in. Rory, I might get you to go first. The stopwatch is on 30 seconds.
30 seconds, okay. Stock on my radar is Constellation Brands, ticker symbol STZ. It's a $42 billion company, controls a huge portfolio of alcoholic brands. In particular, they own the US distribution to Corona and Modelo. That's 2 brands that are very popular in the Hispanic community, which is the fastest growing demographic in the United States. They also own Ballast Point, which makes some very tasty IPAs. And more recently, they took a 9.9% stake in Canopy Growth Corporation, which is a Canadian company involved in medical marijuana. So one of the big questions we get from users is how to invest in the marijuana trend, and my usual answer is don't, but this seems like an interesting way to get into it without the huge risk that comes from investing in some of those over-the-counter stocks.
Perfect. Interesting company. Emmet, are you ready?
I am indeed.
Go.
Okay, so I'm lukewarm on this one, and it's an outlier, but specialty retailers that is shops that you go to for a specialty purchase, I think has been unduly punished in the wake of Amazon. So specialty retailers include the Tile Store, for example, or Camping World Holdings, but the one I'm particularly just moderately interested in at the moment is Lumber Liquidators, provider of hardwood flooring. And the reason I'm interested in them is they've gone through hell and back, frankly, and they have refocused their strategy. Their revenue per employee, from what I can see, is about the highest in the specialty retailer space. They had a pretty good quarterly result recently, and I think that's more due to come thanks to this new strategy refocused on renovations and finding the right customer for their product.
Okay, cool. I think we're going to have to extend our elevator pitch to 60 seconds in future.
60 seconds.
But it was good. It's good. Maeve, which one? If you had a grand on the table right now to invest.
I'm not quite sure, actually. I wasn't expecting either of those types of businesses. I might go for Lumber Liquidators, Emmet. I might put one in your corner. I have friends at the moment who are putting lots of time and energy into hardwood floors and what type of wood they're going to be, so I'll go with that one.
I think I'll go with Constellation Brands. Seems like a very interesting company.
By the way, and we have to vote.
We have to vote.
Yeah, I'd probably go with Constellation Brands.
I'll go with Constellation Brands too. I will.
Hang on, did you fish me?
Sorry, mate.
What a result.
Is this some kind of trick?
So as I've already mentioned, the latest stock of the month report is in the Invest app now. We've also actually added a new star stock to the Invest app this week too. This month's edition is a software as a service, or SaaS company, that helps some of the world's most recognizable brands to embed different types of media into their platforms. I have to say, it's actually a really interesting company, and it's worth checking them out, if for nothing else their values, which are very, very interesting. Emmet, you'll also be publishing a new expert opinion piece next week. You're going to continue your discussion on the key areas for an investor to be wary of. This time you're focusing on the healthcare industry.
That's correct.
Yep. In the meantime, though, you can check out the full archive of expert opinion pieces. There's 12 in total, and you can access them in the You section of the Invest app. That's just about all the time we have for today. If there are any other questions or topics you'd like us to discuss on the Rubicoin podcast, let us know. You can get in touch with us on Twitter or on Facebook. You can leave comments on the podcast episode itself. You can get in touch through the Learn or the Invest app, or you can email us at pod@rubicoin.com. That's pod@rubicoin.com. From myself, James, from Emmet, from Rory and from Meabh, thanks very much, and we'll see you again next month.